Ladies and gentlemen, my name is Mark Mackler, and I will be the moderator for today's webinar presented by Global Sourcing and Global Marketing. All callers will be in a listen-only mode for the duration of the call, but will have the opportunity to type in a question for our Q&A period at the end of the presentation from your GoToWebinar control panel. Presenting with me today will be Mr. Paul Mackler, President and CEO of GSGM. The following is our agenda for today's meeting. Obviously, given the breadth of opportunities, we could be in conversations day in and day out. For today, our webinar will be from approximately 45 minutes to 1 hour in duration, with less time for questions following the general update. Just wanted to mention that we are presenting from both sides of the world today and could encounter a slight delay with slide transition speed. We're very pleased with the breadth of industries represented on the call today. There are individuals online from the USA, China, and Korea. So thank you for joining with us both this morning and evening. With that, I'd like to introduce Mr. Paul Mackler, President and CEO of GSGM.
Mark, thank you very much, and to our honored guests, welcome to our webinar. It's very timely, quite candidly, as you all know. We're really in a period with strong headwinds. We're in uncharted waters, and as they say, it's all in the eyes of the beholder. There will be opportunities with a $10 trillion economy, both for sourcing and sales, and I'm sure that's why you're all on with our webinar today. But first, I think it's important to have a backgrounder on GSGM so you understand some of our history, and then also, even more important, is to understand the real situation on the ground here in China. Now, GSGM has been headquartered in the Rim for over 25 years. We've worked with a who's who of industrial leaders throughout the world. We provided sales and marketing assistance, market research, competitive intelligence, and best cost country sourcing. GSGM is truly a partner, and in fact, in many organization charts, we're listed as a key part of the organization in Asia Pacific. And as part of our partnership together, we provide your company with eyes and ears on the ground in Asia. I think the key is that we have been in over 1,500 plants in Asia. Very few firms, if any, can say that. And in fact, if you look at our client base, over 60% of our clients either have IPOs, plants, and or sales offices on the ground in Asia, and yet they reach out to us for assistance. GSGM provides a broad range of services, and we have a broad range of clients, from large Fortune 500 companies to mid-tier industrial companies, working closely with private equity companies to help maximize the results for their business units, turnaround specialists who are involved with working with major corporations around the world to help them be far more efficient using the Asian connection. And so we're here with a great deal of experience on the ground, looking forward to assist with your efforts to improve your top and bottom line. As we look at industries served, as you can see, GSGM has experience in each of these industries, from precision aerospace to vertically integrated products to individual components. GSGM can assist your company with best cost country sourcing as well as market access. We're providing leadership support to organize project management, sourcing, sales, marketing, competitive intelligence across this broad range of industries, to name a few. Now, it's important as we look at engagement examples to look at the experiences of other companies and the successes of those companies within programs here in Asia Pacific. The first company is an example of a leading global aircraft producer who wanted to expand their sourcing in Asia to support the global operations in Europe, China, and a new plant in Mobile, Alabama. As you can see, our initial engagement was to benchmark the global spend for their corporate consumables. And this is one of the biggest companies in the world in the aerospace industry. As a result of the very positive efforts and success of the program, we were honored to be guest speaker to 24 operating divisions in Europe, on best cost country sourcing. Following that presentation and event, which was very successful, they asked us to be guest speaker to 35 main strategic suppliers to help them to embrace best cost country sourcing. This company was buying 20% of their purchases outside of Europe as a whole, and they were looking forward to increasing that to 40%. We assisted with that effort by working closely with them, and as a result, we're able to demonstrate savings of 30 to 40% from Asia compared to European costs. The next company is a world-leading marine engine producer. Initially, they came to us for assistance on best cost country sourcing in Asia Pacific for their global operations. They have operations at the time in Japan, in Europe, in Mexico, and multiple operations in the U.S. This was a program which was very successfully launched, and we signed a 5-year agreement on the program. As part of this program, we set up their best cost country sourcing initiative across their global division for engine components. It was a 5-year engagement, as I mentioned. We managed and benchmarked. We provided project launch, full PPAP support, and management of the supply chain from Asia. We delivered multiple suppliers of the year globally for the company. We also led due diligence activities on 2 potential acquisitions in Asia Pacific, one in China and one in Korea. The Chinese one also had ties, obviously, into Hong Kong. The chairman made a comment one day with his leadership team to us, and he said, "You're saving more money than the rest of the world combined." The next company is a major global wiring harness producer. This company has over 12,000 employees worldwide and about 3,000 in China. The objective was to expand their market, sales penetration opportunities outside their core business served both in Asia and in the USA. As a result, we worked very carefully. Their core business was in white goods. They're the dominant player in the USA, but they lacked market presence in Asia outside the white goods sector. As a result, we teamed up with them. We provided market research. We identified companies. We made contacts with leadership positions within the companies. We led the introduction and sales calls to potential new buyers in aerial work platforms, automotive, agriculture, off-road construction, and material handling sectors. The yield was that we provided over 70 companies with whom they had no prior working knowledge or contacts with the client, and we identified a potential spend of over $90 million for them to pursue. The next company is a leading auto aftermarket company. And we're just having a little bit of lag on the slide transition at this point here in Asia. And we were engaged by them to help them reduce their cost. And in fact, what we found was that they were buying most of their products through distributors and had no knowledge of who the actual manufacturers were, even though the products would have a label made in China. So as part of this engagement, and again, we were engaged at the C-level within the company, we were chartered with, first of all, helping them identify the suppliers to their distributors in Asia Pacific, and that we did. Furthermore, they asked us to identify additional potential high-quality suppliers that could provide similar products to their stores across the United States, that which we did. They also asked us to negotiate with their current incumbent suppliers to help reduce costs, either directly with their incumbent suppliers and or through their distributors. And we were very successful in that effort. Furthermore, as part of our benchmarking activities, we were also asked to secure pricing from new potential suppliers, send samples to their showroom, which was outside their boardroom at their headquarters in the USA, provide samples, provide pricing specifications, and they had side-by-side layouts of not only the product, but the pricing and the specification. As part of this effort, even in a very mature market, we were able to achieve savings ranges from 20 to 30%. The next company is a leading global alternative fuel engine producer. We were engaged by them initially to help set up the best cost country sourcing in Asia, both in China and Korea, which we did. And this followed by the request of the CEO to have us help him set up the sales and marketing activities in Asia for finished products. We were very successful with this effort. From the standpoint of the sourcing effort, we were able to generate savings from 15 to 40% on the major components. In setting up the sales activities in Asia Pacific, both in Korea and China, these represented the largest growth markets outside the USA for their products. We negotiated contracts with the respective companies. We negotiated contracts with major engine producers to supply engines also out of Asia. We helped them with a joint venture set up here in China. This was a huge win. It reduced costs of components, it increased market share, it increased sales, and globally, very successfully driving both their top and bottom line. The next slide shows the dichotomy of the difference in urbanization. If you see the ships on the left, and these are not Sea Rays or U.S. Marine ships. These are very common boats used in the Yangtze River, for example. And in the back, you see a modern developed city. And this is what's happening in the country today. And it's very important to understand because here's where a large part of the opportunities will develop. The government is focused on restoring equilibrium, consumption, and investment and exports. This is particularly true as it pertains to the western regions of China and the highly developed coastal regions. When you consider this opportunity, one must also consider that 90 million people today don't live in the eastern cities. Within the next 30 years, urban residents are expected to grow by 360 million people, more than the population of the USA or Japan. Furthermore, as we look at urbanization, what we find is that China is on track to have the population of 1 billion people by 2025 in urban settings. Now, this may be delayed somewhat with the current events, and we're going to talk about that further in a few minutes. But to accomplish this, if we move that many people into the urban setting, this means that China would have to build 5 billion meters of road and pave it, build 170 mass transit systems, 40 billion square meters of space would have to be built. That's the equivalent of 5 million buildings. And it's estimated that might represent in the cities 50,000 skyscrapers, which would be the equivalent to 10 New York cities. Now, what we're going to show you later in this presentation is what's happening in the construction industry. It is slowing, but nevertheless, there's momentum. There will be this urbanization. The growth will slow somewhat, but what you're going to see is a major transition from the farmlands and hinterlands to urban dwellings and people living in the urban community. And this will happen. It will improve the GDP of the country significantly. It improves the education process. It improves the medical benefits that people have. So this is very important, the dynamics that we're seeing here. And Mark, if you would appreciate it if you might share some very important information with regard to the China situation today and current data as well.
Thanks, Paul. Happy to do so. So what we want to do is provide everyone with a realistic assessment of what's happening today. And these figures that we're providing this morning are all within the last 2 weeks, so very fresh data. And we'd like to certainly give you our position on this It certainly is not all rosy. There has been some media coverage that has been pretty negative. However, we do think that some of that is a little bit slanted, and we'll give you some rationale behind that as well. So the third quarter GDP figures came out this week showing 6.9% growth. Manufacturing was best among that subset in the industrial sector with about 7% increase. So what we are seeing today, however, is a rising labor rate that has been a challenge and really presents a challenge going forward as well a little bit. The latest figures that we've seen showed wages rose by 8.1% for rural workers and 6.8% for urban residents. New construction fell in the January to September period by 12.6% from a year earlier. And tying into Paul's comments earlier in the discussion this morning, sales of earth excavating machines, as an example, in China fell 35% in September from a year-on-year period per the CCMA. So there's also discussion right now of the government letting some of the larger, more visible state-owned enterprises fail as part of the natural process that the economy will need to go through going forward. One should probably expect that the forthcoming 13th five-year plan will contain some pretty bold moves for the long term. Many of the provinces are currently developing their plans as we speak, and we're looking forward to the contents of that plan as it is released, and we'll share that with all of you at the appropriate time. Citibank has placed its 2016 estimate for GDP at 6.3%, in line with IMF. Citi is also projecting an RMB move potentially to 6.8 by mid-2016. So what does all this mean? It doesn't mean we're going to see a crash. It is a manageable process. China is transitioning from an industrial country into one that is consumer-driven, and many of the things that they're going through right now are necessary to ensure that transition occurs properly. So really, China must move from what we'll call an innovation sponge to that of an innovation leader in the next decade to sustain their GDP growth. And this will be, they've done a really good job with consumer products and innovative production processes, but right now they're trailing in engineering and science-based leadership. An example of progress they're making, however, we can look at the medical equipment sector. So we do have representatives from the pharmaceutical and medical industry on the call today. So companies such as United Imaging and Mindray have done a very good job and are leading the way in their respective area. Importantly, China is spending $200 billion per year on research, second in the world behind only the United States, and they are now leading the world in patent applications. What does all that mean? They've now got to deliver, and that's what we're waiting to see happen as we go forward. And with that, Paul, what I'll do is I'd like to ask you to share some industry examples with the group, and we'll go from there.
Mark, thank you very much. Let's look at various industry sectors. As Mark indicated, some of the various industry sectors represented on the call. We have rail key people, automotive key people as well. So in the rail sector, if we go back to 2014 and we look at equipment export growth rate was 34%, huge. And what you're going to see is China exporting high-speed rail products outside of China to various countries around the world. In the third quarter of 2015, the growth rate was 8%. As Mark mentioned, we're looking at around 6.9% GDP, so slightly above the GDP growth rate. However, in 2015, if we look at the freight volume, we've seen a reduction of 10.9% compared to last year. Now, this is very similar to the reductions that we're seeing in the U.S. on freight hauling. When the economy starts to slow down, one of the first areas one will look at is the amount of freight that's being carried throughout the country and the trends there, and we'll talk about that more in a few minutes. If we look at the automotive sector, where's the growth? Electric and hybrid, 230%. We've all heard BMW, Audi, car companies all over the world are working on electric cars, and that will be part of our future, and hybrid cars. And so we're going to see a change in that area. We have to adjust for that with many of the people on the phone, how that's approached as well. But we've also seen that our sales are only about 5.2% up compared to last year. Normally this would be in double digits. So if you extrapolate the 13.8 million cars sold to date, that's about 18 million cars plus this year, which is very good. However, it normally would be expected to be much better. And within that sector, where the growth is occurring is in SUVs. As you can see, there's been a 62% growth in the SUV sector. So these charts are very important to understand. If you're a general and you're on the battlefield, for example, the first thing you need to know and determine is the real on-the-ground situation. And then you also, at that point in time, develop what your offensive strategy is. And to that end, what we need to do is look at which sectors offer opportunity. Now, again, we have a $10 trillion economy, which will grow somewhere between 6 and 7%, depending on which economist you follow. It's still a very, very significant market. Now, as we look at other sectors, we look at the truck and bus sector. Again, truck has to do with the construction industry. So if you look at the truck sector right now, it's down 44%. And if we go to the slides towards the bottom there, you look at mixer trucks, those are cement mixers, that's down 49%. And go just above that, the dump trucks, that's down 75%. So you can see the construction industry is slowing very dramatically here in China, and the capital equipment that's being purchased to support that. The CEO of Caterpillar was on CNBC, for example, yesterday, talking about very strong headwinds that they're faced with as a company globally for construction equipment. When we look at bus sales on large and medium-sized buses, those are both down also. The small bus sector is slightly up to 5.47%. So we're seeing a slowing in the transportation sectors. The car sales are still positive, but down. Rail on carrying of cargo is down right now. The dump trucks, cement mixers for construction is significantly down. And so this sector is being very strongly impacted. Now, as we look at the next slide, which is pharma and medical equipment sales, hey, this is a very positive area. We're looking at China with 1,300,000,000 people. We've got an aging population. They're providing improved medical care every day. People are living longer. There are new hospitals and clinics springing up all over China. There's new advanced care facilities being built. The employees in China have improved social and medical benefits. So as you can see, the growth rate ranges in the various sectors shown above from 5.6% to 12.65%. So this is a positive area. So what we're seeing is a mix. There are areas that are up, there are areas that are down within the economy. If your areas are up, obviously you want to participate in that and maximize it. If the areas are down, you need to look at your strategy to gain maximum market share in that market that's in place. Now the market share here is very large in all these sectors. Construction equipment wise, even though it's down, they build over 60% of all the construction equipment in the world in China. Now, as we look at trade data, and we're going to compare China and India here, exports in China fell 3.7%. That's not a major change. Imports were down 20.4%. So what we're seeing here, and this is not a surprise, this is a trend. Let's go back to January, and you can see this starting to develop very consistently. So it shouldn't have surprised anybody. It's like the stock market, they get a report and they overreact. This has been occurring over the last 9 months. It's not a surprise to anyone. Now, if we go to the next slide, in India, they have an even tougher situation in this area. As you can see, exports have dropped by 24.3%, imports by 25.4%. They're in a steep dive right now, both on imports and exports. And they do not have the benefit that China has of a long trade surplus with countries that they trade with. So India is going to have even deeper problems, I believe, than what China currently has. If we look at the next slide, what we're seeing is a shift in the market from a manufacturing-focused market to now over 50%, 51.4% are in service industry sectors. This also offers an opportunity. We have to understand this change and try to embrace it. The next slide is important because we're seeing charts up and down, for example. Consumption and services have been rapidly increasing. Construction manufacturing has been decreasing. Rail freight traffic is down, but passenger traffic is pretty stable and a little up. Aviation has been reasonably stable. However, China is the second largest aviation market in the world. So there's huge opportunities over here in this market for new aircraft. China will also be building their own commercial aircraft, which is a unique opportunity for many companies. As we go to the next slide, the China economy is slowing and not stopping. That's what's important to understand. It's not stopping. We're going to have between 6 and 7% GDP growth rate during the next 5-year period. If you look at that growth rate and you look at it over a period of 5 years, the value in terms of dollars of that GDP growth in 5 years is equal to the total economy value, if you will, of the UK. So this is a massive opportunity as well. The 6% GDP plus growth rate, we need to get used to that. The 12% days are over. We're going to be running 6% probably over the 5 years, 6 to 7% over the next 5 years. So we have to make this, look at it as an opportunity, again, to try to gain market share wherever possible. As we look at sector bright spots, and there are many bright spots in the economy, we talked about briefly aerospace sector and U.S. exports is up 21.3%. Pharma is up 14.6% to China. Electronic goods are up 10.5%. So these are all areas that are growing in double digits, and there are others, of course, as well. So we want to look at how best that we can penetrate those markets. Also, keep an eye on this urbanization side, because this will also provide an opportunity for you to provide technology, equipment, services that help support that urbanization itself. I'd like to ask Mark to present a very creative approach to looking at GDP. And Mark, if that's possible, surely would appreciate it.
Thanks, Paul. So in the media, there's a lot of question as to how valid the China GDP figure is. And I think the general consensus amongst the population is that there's some fluff there. So a little background on an alternative index that was created. There was a provincial leader who is now in a very senior position in China's government, meeting with the U.S. ambassador several years ago to the United States. And in that discussion, and the notes from this meeting made it out into the general public, but in this discussion, he said, look, I don't believe in the GDP number. There are some issues with that. So what I do is I look at 3 metrics that really tell me what's happening in China. And he shared this sort of off the record with the ambassador as part of our wonderful WikiLeaks and things like that. This document actually became public. But the 3 particular indicators that he looks at are electricity consumption, rail loadings, and new debt issued by the banks. So he said, that's how I gauge the health of the country. So when we look at that, The Economist magazine then subsequently put together this matrix. And what we see on this slide here is this alternative index versus the GDP is still actually showing GDP above 6%. So, you have people coming out saying they think it's 3, they think it's 4, they think it's 5. In reality, in looking at all the data points that we look at, seeing what we see on the ground and the activity levels on the ground, measuring that against what people really believe is maybe a better index. Again, we are still seeing a 6% number today. With that, Paul, if you want to speak a little bit about currency, what's happening today, and maybe where we see ourselves going forward, as well as some of the competitive countries would welcome that.
Well, thank you, Mark. And as you all know, when you listen to financial reports being presented, almost in every case now, your multinational companies are talking about the impact of foreign exchange on their earnings. And of course, it depends where they're located and whether they're selling to those locations, buying from it, what the changes in currency have been, during that period of time. Obviously, it affects the top and bottom line. So as we start to look at this, what we find is that the Chinese currency has changed 3 to 4%, depends on the day you look at it. And what we've also found is that as the banks have, if you will, allowed additional funds to come in the market through reduced interest rates, it affected the stock market as well. So we went through a very dynamic period of time. So we're going to talk about the stock market separately from currency, but they kind of internally entwined, if you will. So the government has seen their exports declining. They made a move of 3 to 4%. It created news all over the world, and that they were taking advantage from a currency standpoint. But did anybody say anything about the Mexican currency moving 23% versus 3 to 4, or the Japanese yen moving 12% in the last year? Almost not a word. So the move of 3 to 4% is insignificant. Some economists have suggested that China would have to devalue their currency by 15 to 20% to make a major difference in terms of their GDP, and that's not likely to happen. At the same time, China would like to see their currency used as a reserve currency. Sometimes it's referred to as a special drawing rights, a basket of reserve currencies that are recognized globally. And as you'll note, the US dollar, the British pound sterling, Japanese yen, and euros are all part of that market basket. And China desires to have their currency be recognized as well. IMF indicated it would not be included for at least a year. So from a strategy standpoint, the question is whether they make an additional move in currency prior to that period of time and then provide stability on the currency. When we get to subsequent information in this presentation, you can see that they've actually increased their currency less than most of their major competitors. And as you also note here, Citibank has indicated that they anticipate the RMB to US dollar could move to 6.8 this year. We're thinking that it might also move an additional 5%. Now, as we go to the currency chart, this is a very interesting chart. So as we look in the upper left quadrant, you'll see the Mexican peso has moved 23% in a 12-month period of time. They've devalued their currency by 23%. The Korean won has been devalued by 7%. The Chinese have devalued their currency by 4%, and the Japanese yen has been devalued by 12%. What does this mean? This means that China, by virtue of these other countries devaluing their currency, has become less competitive. So they would have a desire to try to move their currency. Let's go to a real outlier, Brazil. Brazil has devalued their currency 57%. 57% in this period of time. India's has been reasonably stable at about 6%. But in every one of those cases, they've devalued their currency more than China. So with the chart that's currently up on the screen, you're looking at a 5-year window of period of time. During that 5-year period, if you go back to January 13, 2014, when the currency was 6.04, and you go to the current date, let's say of October 18th, or you make a move into October 18th, there's been about a 9% change in the currency itself. There has been a recent change of about 4% back up, but the net change actually has been about 5% down over that period of time. So they have changed their currency very little, if you will, look over that 5-year period of time. Let's look at the stock market. Everybody's heard about the stock market and the major crash in China. I think we need to understand what happened there and what the current situation is on the ground there as well. So what we had is a situation where the stock market doubled over a 16-month period of time. Remember I mentioned interest rates were reduced at least 3 times during that period of time. And what happened each time the interest rates were dropped, people would borrow more money, they started into the market, and many times the stock market would move 10% on a stock, it would be stopped for trading that day, and the next day it'd go up and that stock would move 10% more up. So everybody was making money easily, everything was on the upside. And if you look at that, the foreigners are prohibited from going into certain markets, and therefore these are mostly individual investors, which account for 90% of the turnover in the equity markets. And as a result, what we had was people investing their money personally, their family's money, their friends' money, and going into the market as fast as they could. And as you see here, about 25% of the people that were doing trading had only received elementary schooling education. So as we go to the next chart, we're going to see a huge spike. And if you look at that period of time where that spike was occurring, there were interest rate drops also during that period of time, the 3 we talked about. This crash has generated significant concerns globally, rightfully so. But we need to understand what happened that caused it, the people that were investing in it, and the lack of experience. Now they'll be very careful as they go back in the market. During this period of time, there were over 3,300,000 brokerage accounts in China. And the market value when the crash occurred, the loss was about $3 trillion in market value. But if we look at the market today from 1 year ago, the Shanghai market, is still up 43%. And this will be the next slide that'll be coming up. And it's still up 43% in spite of the crash. And if we look at the Shenzhen market, what we're going to see also is that the Shenzhen market is up 44.4%. So if you looked at it like Warren Buffett would say on a long-term basis from year to year, yes, you're up 43, 44%. If you look at the top of the spike and you got in the market at the peak and the $3 trillion was wiped out, yes, one would have lost a fortune potentially. Now, going forward, part of this is about confidence. It's about confidence in China in the market, but it's also about confidence in people who are working either from a sourcing strategy in China or a market strategy into China. So let's talk about that next, because that's part of the reason we're all here together today. Again, we talked about currency with a 4% swing. We think there might be another 5% possible by mid-2016. So that being said, the factories are not fully loaded. They're getting more aggressive on pricing. You essentially would almost have a 4% reduction potentially in pricing now. And if it goes another 5% through appreciation, there might be a total of 9% that one could start negotiating with the supply base to reduce cost. As you know, duty payments into the U.S. market and European markets are based on, to a large extent, the purchase price of the commodity. So if the commodity price has gone down 5% or 9%, that also offers a significant reduction. Today, materials are more affordable. If we look at iron ore pricing, we look at precious metal pricing, and even aluminum ingot, before the government had duties on it to restrict its export up to 30%. Some of those duties have gone to 0, some have gone to 15%. So there's a lot of excess capacity and raw materials available. That's going to continue to open up. We also have the country's 13th 5-year meeting coming up with the central government where they'll provide the next 5-year plan. And I'm sure, absolutely sure, they will be addressing many of these areas in their master plan for the next 5-year period. Now, as we look at additional areas of opportunity, one area that companies are using very successfully now, and that's vertically integrating their products wherever possible, not only to reduce their costs increase our ROI, but drive the top and bottom line, because the manufacturing cost, the labor cost, the cost if you're machining of castings and so forth over here are much less than they would be in the States or most other parts of the developing world or developed world. We use the infield-outfield approach. Products that you produce in your plant today and you have significant margin, keep those in your plant. Those products which are marginal or your trading dollars, those products should be moved to Asia to try to generate additional margin and profitability. Foreign and direct investment, FDI, you hear a lot about this. What we're seeing is not only are the Asian companies investing in the U.S. market, companies like Wangxiang has about 8 plants in the U.S., a couple in Mexico continue to invest heavily. So there's investment money coming from Asia to the States, and also we're seeing a number of companies looking at either setting up WOFIs, wholly owned foreign enterprises here, or joint ventures in Asia, and investing foreign direct investment dollars, if you will, to support that. Develop supply agreements with exclusivity to block competition from coming into the USA and check them globally. In many cases, this is a great strategy if you have similar products. Work with them on a low-end product where there's no margin, brand it with your company's branding, if you will, and have exclusivity so they can't come into the market to compete with your core business. Utilize the China supply chain as supplier to your plants in the USA, but those same suppliers can be locked in and become your beachhead, either for finished products or semi-finished products, into the largest developing markets in the world in Asia Pacific. Add new product lines, as we mentioned before, which minimizes capital investment, CapEx, because you're able to utilize equipment technology that's in place here in Asia Pacific. Also, you need to have a product diversification strategy, because the world is changing very quickly. Like as we look at, if you will, spark ignition engines, gas and or diesel, now we're seeing electric vehicles coming and many being developed. Yes, it's not here yet, but it surely is being developed. It surely will happen. So the companies who are producing engines, for example, have to offer products to compete with the electric engines in the future. The casting plants that are producing blocks and heads and manifolds and so forth, that business to a large extent is going to start to be reduced. That's an opportunity from a sourcing perspective, because that will open up capacity for you from the procurement side. Also consider very carefully foreign exchange impact, the financial viability of your suppliers. You need to get financial statements on each of your suppliers to determine their viability. And that's not only true here in Asia Pacific, but in the U.S., and we can help with that. Quality audits and follow-up to see that they're following the processes, procedures, and controls that are in place. Product producibility for products today, tomorrow, and the future. Price competitiveness and real cost of ownership, and how you can work in partnership with your supply base to improve pricing, maintain margins, and move forward very positively. Target suppliers offering productivity gains and cost reductions. This is also very important because it's an ongoing work in process to try to have most cost-effective products going to market. Target suppliers utilizing the innovation sponge, Mark mentioned the sponge earlier, that are absorbing and adopting existing technology and knowledge from around the world in their processes and procedures. If you look at the metal industry, for example, here in China, China has more advanced metal making technology than any country in the world. And this continues to grow here as well. Look at their efficiency, their utilization of latest engineering and innovation, and the commitment to continuous improvement as part of their facilities. Now, as Mark had mentioned, China has embraced this in many areas. As you know, from household appliances, they are a global player today, internet software and services, solar panels, construction machinery equipment, high-speed rail, and so forth. So in many of these areas, they've embraced these technologies, they've embraced these opportunities, and have moved forward very positively and proactively. From a selling opportunity standpoint, Where else can you find a $10 trillion economy and only getting larger? That's China. You have two economies near that level, and that's the U.S. is number one, China is number two, and then it falls away dramatically. So China still is a major opportunity for selling of your products made in the States and or from operations here in China. And so you need to look at market penetration, market expansion, product expansion and acquisitions. We've worked in each of those fields helping companies, and we'd be very pleased to work with you to help make your company even more successful. Let's take a $10 trillion economy. If we were to grow at 6% per year, that's $600 billion of new opportunities that are being created. And don't forget, we still have the base level, if you will, within the economy itself that one has an opportunity to pursue. In country for country, in China for China, sales opportunities are also an excellent opportunity for you. You don't have foreign exchange variations because you're dealing on a level playing field within the country. You have the same basic labor rates in the country. You may add more, if you will, quality control systems. You may add more productivity through automation. This will give you an advantage position-wise because you'll be able to offer better quality, better performance of your products, and the markets will demand that more and more as time goes on. With rising labor rates, people say, well, geez, labor rates are going up in China. It's true. However, at the same time, if you go west, there are lower labor rates, there's lower energy costs, there are tax incentives in many of the provinces to promote business. And if you look at the GDP growth rate, province by province, as you go west, in many cases the growth rate is higher than on the East Coast as well. So what we like to do is look at, for example, the importance of market studies, because we have many people come to us for these studies. This is critically important because right now you're saying, what do we do? The market has gone down if you're in the sales side. Well, there's $10 trillion out there. Where are the opportunities for you to expand your markets, your current markets, or with additional products? What are the channels to get at that? What's the potential return on investment? And this is all part of a business plan for the future, and we can help with that. When we look at one's business and market share, we cannot be sitting back and say, well, the market is declining, yeah, we're going to grow at the GDP growth rate within a sector. That's unacceptable. We have to be focused on being leaders within the markets we serve. We have to be focused on growing much faster than the markets and our competition within those markets. That's what a leadership is about, and that's where we need to be focused as well. Diversification of products, and again, utilizing capital deployed within the operations is really critical as well. So if we look at, in conclusion, of where we're at, again with these headwinds, again with the stormy waters and so forth, it's not so bad. Okay, we have 6 to 7% GDP depending on which econometric model we're looking at and who we're speaking with. 2016 will be a challenging year, but nevertheless there will be growth. 2017 we believe will get better. We think the 13th five-year program will help to focus on that as well. China will continue to focus on improving the environment and improving the situation for the people in the country, as evidenced by the medical field here as well. Furthermore, if the currency is depreciated a second time, this will make a purchase opportunity for companies from a sourcing standpoint. And if you're in country for country, even if there's a change in the currency, it doesn't affect you necessarily from a market standpoint. In reality, the opportunities are not universal, but if you have the right product or service for China, there's everything to play for on the market side. Again, think about in-country for country, wherever it's viable and feasible. Good companies master disruptive change. We have that opportunity at this point in time. China market and sourcing strategies remain opportunity. As we said, there's an old saying, the only limitations are those of vision. I truly believe in this. We must always strive to be the best in the market served. And with that, again, I want to thank you for joining with us today, and I'll turn the discussion back over to Mark and for any questions and answers from our participants.
Thanks, Paul. Appreciate that very much. Thanks for the information. As Paul mentioned, and as I mentioned earlier in the discussion, on the right-hand side of your control panel, there is an opportunity to ask questions of the team here at GSGM. We have just about 3 to 4 minutes left. However, if there are additional questions that go over this period, we're happy to answer those via email, set up any teleconferences that you might wish, and happy to help in any way possible. Let me just go here. Okay, Paul, the first question we got from the group is, geographically, where do you see opportunity for sourcing in China?
That's a great question. From a standpoint of sourcing, the closer you can get to your supply chain, if you will, of raw materials, that will reduce your costs. Secondly, remember when everybody was younger in the States, they had Go West and Go West for gold. In China, it's Go West for lower labor costs, lower energy costs, for tax incentives, and going near the material base. Also, as you go west, you try to stay somewhat close to Yangtze River, because if you look at the tonnage of materials moved across China, still movement on the Yangtze River and other waterways is extremely high. So I would recommend you look at going west. It's like a world within one country. On the East Coast, labor costs are higher. But as you go west, the labor costs get much more reasonable.
Thanks, Paul. And next question, which I should have mentioned actually at the beginning, was, can we receive a copy of the slides from today's presentation? Answer is yes. What I'll be doing is sending out a PDF version of all the slides to each of the attendees the early part of next week. If you need them sooner, feel free to call Paul or I, and we can certainly arrange for that. Okay. Next question, Paul. Have you seen a shift in your business from sourcing to marketing?
That's really a great question, Mark. Yes, we have. When we first set up over here, virtually 27 years ago, in Korea, then China, and so forth, Asia, a lot of that effort at that time, in fact, the vast majority of that time, were sourcing, helping companies reduce their cost, improve their sourcing, get a beachhead on the ground with their sourcing activities, and subsequently joint ventures and factories. But what we're seeing is that more and more American companies have become more cost competitive through their sourcing efforts out of Asia Pacific. Their markets have moved here. If you look at the automotive sector, every major producer out of automobiles in the world is here. Every major truck producer in the world is here. Every major producer of forklifts is here. So virtually the whole supply chain, the value chain, an opportunity for sales has moved into China. So what we're finding is that our business is close to 50% for sourcing, close to 50% for marketing. So there are opportunities in both directions. We have companies getting three-way plays. One-way play is sourcing, move the products back to the States, make finished products, move it back to Asia, and then subsequently the final products, if they're moved back into the States, need certifications, and therefore the importer of record has to have those necessary certifications, and this allows them to have a triple play. So there are a lot of opportunities, and as Mark mentioned, we would welcome setting up subsequent calls, meetings, discussions, webinars, and conferences with your fine companies to discuss how we can help you be even more successful here in Asia Pacific.
Okay, Paul, looks like we have time for one more question, and I'll read that up here. It says, I currently have customers in China selling medical devices. I keep hearing about the coming global economic reset and revaluation of currency, similar to what happened when the world went to the USD from the British pound after World War II. What are your thoughts about a global reset on currency?
I would see, and I think it's a great question. I think where we have to watch is what's going to happen when the RMB becomes a reserve currency. 90% or so of all the global transactions in the world today are in U.S. dollars. And the RMB will become a reserve currency at some point in time. So it'll be very interesting how the trade might change when that occurs. And I would anticipate there'll be, as you noted, that Mr. Xi was in England meeting with them, and they've done a large amount of sales, nuclear plants going into the UK and so forth. It'll be interesting at some point in time whether that's all paid in British currency or whether that ends up being paid as part of a swap with RMB. It'd be very interesting to see what happens there. Also, what's happened if you look at the investment of the Chinese government into treasuries within the last couple months, for the first time in many years, we've seen a reduction in the investment in treasuries. Now, I believe, and I haven't looked at the most recent numbers with the central bank here in the last week or two, but I believe there's about $1.2 trillion invested there. And I think in the Japanese yen, there's something a little bit lower than that. So both China and Japan are funding our debt to a great extent. So I think from the Chinese government standpoint, they'll probably be looking at where they best invest their money, where they best their currency to get a return. So I think the major reset that we need to watch will be the reset when the RMB becomes a currency, a reserve currency, and it will at some stage in the future.
Okay. Thanks, Paul. With that, we'd like to thank everyone for their participation today. We've come up against our stop here, but I'm happy to answer any questions that come our way. I'll respond to those by email, along with the slide decks that will be sent out early next week. On behalf of Paul and the GSGM team, we'd like to thank everyone for your participation both this morning and this evening in Asia, and look forward to speaking with you soon. Thank you very much.
Thank you.